Okay. So, a very good afternoon to everyone, and welcome to IRIS MSME webinar series, where our idea is to share information, share knowledge uh, about what's happening around, which has a direct impact on MSMEs, how they perform, how they grow. So that is our small, I think, initiative towards keeping MSMEs updated with the developments. And the topic that we have picked up today is, of course, the one which is of the highest importance to MSMEs, because, yeah, whenever you go and talk to MSMEs or anything that you read about MSMEs, the first thing that shows up is there is a huge credit gap for MSMEs. And why is there a credit gap? So if you see one, there are, of course, banks and financial institutions who are willing to lend to MSMEs. On one side, you have MSMEs who are also ready to, go and get the finance options available, but still there are a majority of MSMEs who are still not getting the funds that they need. So either it is the issue of not having the proper information with them, or it could be there could be some apprehension why they are not approaching and getting the loans. Hence what we want to cover today is, when we talk about loan, the first mindset that comes is, oh, am I not doing well, or do I really need to take a loan? So those myths and those some of the misconceptions around the loan is what we really want to clear, which we hopefully think most of our MSMEs who have joined the webinars are already progressive and would be pro taking external finance options, but nonetheless touching upon what clearing the myths around the loan aspect when it comes to MSMEs. But we are not stopping there. We want to really go ahead and talk about, once you know you need a loan, you need some financing options, what are the different types of options that are available, what things you need to take care of, what you should not do. So those some kind of tips and expert things is what we would really like to share in the webinar today. And in the webinar today, we have with us Abhishek, who is a seasoned expert in this industry, who has seen closely MSMEs, how they deal, the kind of challenges that they face, and has also helped them to, finally get the finance, the loans that they're looking for. So I'm sure his, vast experience and real on ground, what do you say, the experience that he has will be really useful in the webinar today. And before we actually jump into the topic for webinar, a little bit brief introduction about IRIS. So IRIS is a global regtech company. We have been, working with regulators across countries and with companies across the globe for helping them to meet the regulatory compliances, and to the regulators to help them build the platforms which they can use to collect data and do an intelligent and smart supervision. So in India, like RBI has been one of our clients since 2008, and we have helped them to get all the streamline the reporting which the banks, NBFCs have to do to RBI. And while we started as a regtech company building solutions for regulators and enterprises, MSME, which is actually in any country you go, they are the most called as the backbone of the country, helping them contributing a significant to the GDP, to the export. So there is something we wanted to do for this segment, and hence we started the initiative IRIS MSME, where we have tied up with strategic MOUs, memorandum of understanding, with various governments like Karnataka, Telangana, and Goa. Along with these regulators, what we are planning to do is create a platform which can help the MSMEs to be more digitally savvy, get things that they actually need for. More about that, maybe we will talk towards the end of the webinar. But for now, we will just focus on the topic of the today, the business loans, and how MSME should make most of it and get most benefit of the loan option that they're looking at. So yeah, so Abhishek, over to you. And to our audience, if you have any questions, if you're already using Iris Peridot app to watch the webinar, you can always type your questions. We will be happy to address that. Or if you have it at any later stage, you can always write to us. So for now, yeah, I hand it over to Abhishek. So the stage is yours.
Thank you, Shilpa. Thanks a lot. Good afternoon, everybody. Hello and namaste. It's wonderful to have you all here and join us in this discussion that we want to have. Primarily, we are talking about loans here, but if you look at slightly more closely and deeper, this is not about loans. This is more about how MSMEs can actually, contribute more, get educated more, and know their worth in this entire ecosystem, work through their potential, and contribute more on the socio-economic factors of the country that we are kind of looking at, and how loans can actually be more of a tool rather than a hindrance. And we want to look at it in a more structured, organized way, find the goods and the bads, the pros and the cons, and see if this can be utilized and understood better. So, how are we going to tackle this broadly into four broad segments that we want to look at it? We would talk about loans per se, the perceptions, how do we look at what we have been seeing, and how this actually impacts our outlook towards loans. And if at all we feel that loans are not as bad as we perceive them to be, or we have been made to see them, can they be used and how effectively it can be used? Then we would look at some cases wherein it actually helps MSMEs, and then maybe we'll try to learn from them and apply that knowledge to our own self. And lastly, we would want to get deeper into understanding like what are the different kind of loans, when they are required, where and how you can take that, and what are the pitfalls that you should avoid, and what are the points that you should cover while we are looking at these loans. So moving ahead, first of all, the very common perception: loans are bad for business, and that has been the understanding, that has been the common, I would say, perception, that has been the common, outlook towards the loan, because we have been told that loans are often, a circular trap wherein you get into one and then you can't come out of it. And a lot of it goes to the probably the way we have been growing up in our entire ecosystem. Movies have been most influential in terms of our upbringing and forming our beliefs. But and that's where we have seen, like, a common farmer or a common poor businessman taking a loan from a lender, and then he keeps on paying interest. He never is able to recover from that trap, and then ultimately that becomes his downfall. But that's true in a sense, but not the entire picture. It's only part of it what we are seeing it. Just like that old story of, four blind people looking at elephant and describing in different formats. That's how probably one of the ways that could be, but there is more to loan than what it is. And there is also a cultural bias. I mean, I'm sure a lot of us would have remembered a very famous gold loan company going all out in the market with a major Bollywood actor telling you that jab ghar mein padao sona to fir kahe ko rona. Because again, we have been told that, ghar se gold agar girvi rakh diya, that means that's the end of the life, or that's the most uh, a hit one can take on their ego per se. But that's again not true, because gold, though we have been accumulating, building as a wealth resource, but we never unlock its true potential. And if you don't unlock its potential, then what's the point in having that wealth? And that's where that entire campaign was there, that gold is something which is there for you to use it properly, and then obviously you can be more in your life, in your business, in your social standing. Again, there is this huge thing of repayment. Interest ही interest आते जा रहा है, मैं क्या करूँगा? Lot of misinformation that loans are bad, assumptions that loans are bad for business. All of it is true, but again, like I said, only partially, because unless you know how to use a tool, you can't blame the outcome, right? So you should know which loan is required for what purpose. You should know how your loan is getting serviced. You should know how and where you can take the loan from. And that's where we need to kind of analyze before we judge loans being bad. So more of it while we go across, and more of the slides, but very, very essentially, what I'm trying to say is that just like नमक खाने में जरूरी होता है, अगर कम रहे तो खाने में स्वाद नहीं आता है, और अगर बहुत ज्यादा हो जाए तो खाना खराब हो जाता है. So I would want to put that as a simile while going forward, that loans are like that namak, which can actually enhance the taste altogether of your dish rather than making it distasteful or not eatable. Um, so primarily, loans are not equal to losses. All the businesses that we look at, uh, they take loans. If I were to ask all of you, which is the biggest business house in India, all of us will name in the top three Ambani's or Reliance as the biggest one, and they are right. Not just in India, one of the top business houses in the world. Uh, do Ambani have loans? Yes, they do have loans. I mean, I'd be surprised if you would Google and find out how much loans Ambanis do care. So, Ambani's, if I need to put a perspective, their entire revenue for last year was around 10.7 lakh crores. And what is their total gross debt? It's around 3.8 lakh crores. So, almost 40% is their debt. But are they into losses? No, they are making money. They are growing by leaps and bounds. They're opening a business. Just a small simple fact. Today, everybody knows and uses Jio as a telecom company, right? Jio was started with a loan of 2 lakh crore and now they are moving into profitability. So loans are not equal to losses. Uh, Loans are financial tools which are utilized to create a platform. They are not burden. If you use them properly, you will be able to grow, and that is where the loans will come handy for you. Why and how do you do that? So first of all, most important thing is you need to look at the income versus expense part of any equation, like you do in your business. Like whenever you get into a production or a trading, you look at your costs, you look at your overheads, and then you look at your selling price, and then you come up with the profit. That's exactly how loans also work. So if you are taking a loan, what interest are you paying, and what is the income that you're able to generate? If there is a positive outcome over there, loans will not impact your business negatively. Secondly, loans does not mean that you're transferring the ownership. Loans just means that you are taking a help from outside and the ownership remains with you, unless of course you are submitting certain papers or documenting in a manner that you pass on that ownership. But yes, loans directly do not affect the ownership. And obviously, if you know your business, if you are very confident in what you're doing, if you know the process well, loans do not impact business negatively. The risks are minimized only as much as they would be there in the normal circumstances. So yes, loans typically, if used well, would be a major growth factor rather than a limiter for your business. Now, let's assume that you don't want to take a loan, right? There is a business opportunity. You are into a business of selling, let's say, utensils or maybe clothes or garments. You don't want to take loan, and there's a huge festival season coming up. You can only stock the amount which you can fund yourself. Now, your competition could take a loan, could take a loan which is comparable to the cost of profit margins that you are having in your business, and obviously he can sell more than you, right? So, one, you miss out on a business opportunity. Secondly, um, when you are generating income from the business and putting it back in the business, it impacts you on two ways. One, obviously your personal income goes down, and secondly, the only limiting factor in terms of expansion becomes the amount of money you can put in, and that's where again you will lose out on the competition. We all have seen the market that we operating in. We talk about all these startups, we talk about all these companies which are there in the market for us to see. There are businesses who are expanding because they have a working business model. They are taking loans and they are moving in the expansion phase much more rapidly than their competition. Um, Secondly, if you're not present in your markets, if you're not present with the right kind of stocks and the total value of the stocks, obviously you're losing out on the market share. Bootstrapping, which is basically funding your own business through your own money, it has own limitation and it will compound going forward because the competition is huge. So taking a loan makes you miss out on a lot of things, not just on the growth and profitability, but also in the long-term sustainability of a business. Uh, Now we will just look at how these loans are, can be beneficially for you. So typically, I'll give you a couple of examples. Like Shilpa mentioned, I have been fortunate enough to work with MSMEs for a lot of time in my career, and I've been fortunate to talk to a lot of the businesses. One of the business that I remember, which actually was a very smart businessman, just like a whole lot of you. This guy was in the business of selling yoga mats. Now suddenly, Government of India started the World Yoga Day, and it became a huge event. So initially, this guy was selling yoga was not such a big thing or a huge thing. Nobody would really go out and buy a yoga mat unless you are instructed by your yoga teacher, which will only come in your life if you happen to join a class. Otherwise, nobody is bothered about yoga mats anymore. But suddenly, Yoga Day, 21st of June, that's I believe the day, right? So it became a huge thing worldwide. And we had these events across offices, schools, societies, so common places when people were wanting to do yoga. And if you're doing yoga, what you need? You need yoga mat. So this is where this guy comes to us. He takes a loan, a small guy, he takes a loan of 10 lakh rupees. He stocks yoga mats, right? He came to us in April, took the loan, stocks in May. June he sold, I mean, he sold like hotcakes. He sold like almost, 80% of his annual stock. And then he repaid the loan back in the month of November. So what usually happens, coming back to the previous example that I was giving you, what he's doing is using very smartly a tool which helps him grow his business because there is a seasonal opportunity. So there is a a possibility of using loans to your advantage. Again, the smart thing that he did was he chose the right kind of loan to have, and we'll come to that in the later slides. But yes, it gives you that support in terms of managing your business opportunities. Also, if you look at the people who are into manufacturing segment, typically a manufacturing segment will have a 90-day or a 60-day of a working capital requirement or a cycle. Now this becomes a challenging proposition to manage. You need to buy the raw material, you need to stock it, you need to pay your wages to your laborers, you need to put in a lot of other overhead expenses of electricity, maintenance of the machines, and whole lot of things. Then you prepare a good and then you sell it off to the traders or the contractor to which you are taking order from. So all of this takes time, and then you have your payment cycle. So typically, if this is the kind of scenario you're operating in, you would be limited by your growth if there is a slight change in the payment cycle from your vendor, or there is a slight change in the demand of your supplier. So if somebody wants a 30-day cycle instead of a 90-day, you need to fund it from your own pocket. And that's where loans would come into picture. And loan not only helps you work on these opportunities, they will help you smoothen your operations on a day-to-day level. And so this is where you need to look at, again, re-emphasizing on the fact, take the right kind of a loan. You should not fund a loan with, I mean, you should not fund a situation with a loan which is not suitable for that. So we'll come back to that again. But yes, it helps you with all of these things. In terms of specific cases, what it helps you stock inventory, just like yoga mats, before the peak season arrives. It can be for a rainy season. If you're selling umbrella, it's only required in certain months. If you're selling stationery, required only certain months. If you're selling garments, obviously there is a festival season. So different kind of businesses will require different kind of cycles, and most of them do. So yes, it helps you address that. It helps you also manage specific demands which would arise in the market, not impacting your regular cash flow cycle. More importantly, it reduces your dependence on informal lending. Now, I'm sure there are a whole lot of avenues which are there in the market, and since you are in business, you are much more aware what are all those options, who can give you money whenever you require, just a phone call away. At times it can be cheaper as well, but what it does, it is into a informal lending. As India as an economy is moving more towards a structured and formal structure, we need to have our credit footprints, and these are important to have your loans in place, important to have your better structure of loans in place, because it helps you avail better finances down the line. Loans are simple if you look at it from a lender's perspective, risk versus reward. So if there is a higher risk on a certain profile, obviously they would charge more interest. So if there is a better credit profile, if you are having good repayments, if you are having a formal lending footprint, obviously not only you get more money, you get it cheaper as well. So that's where it helps you, and also it makes you not just fulfill your business requirements down the line. We all do have our personal ambitions, we all do have personal goals. Buying a house is obviously one of them for almost everybody of us. Getting a home loan becomes much more simpler, easier, and cost effective, so if you do these kind of things. Now again, what does getting an access to a formal credit means? Now it gives you a structured repayment mode, and it gives you transparency. You need not succumb to the pressures of informal lending in terms of the erratic demands of high cost of loans at times, because everybody knows there is something called as a Pathani Byaj in the older parlance that we used to talk about, which talks about very high rate of interest. And this goes back to that reference which I was making, the old movies wherein the poor farmer or poor businessman would die under the load of interest. That's what it is, which goes as high as 5 to 10% monthly. So a formal credit reduces that. It also improves your planning, it improves your credit score and future borrowing capacity. Again, I would want to give an example. In my experience, I happened to meet one gentleman, hardcore businessman, coming from a typical third generation of businesses. He was taking a loan from us, and while I was meeting him, I asked him, sir, why are you taking this loan? I mean, obviously you get a loan which is much cheaper in the market, and also you get probably more money that I'm offering you. Then he told me, Abhishek, it's very simple. I have that access, but what I'm trying to do is, again, I need to take this loan because I am planning to take a home loan in about 2 to 3 years time. If I have a good credit score, if I have a good repayment history, if I have a good presence in those aspects, then obviously not only I get a good loan, but also get a better rate of interest, because now my family is expanding, my son is getting married, and we need to move into a bigger house. So that's very intelligent of him, and that's where having a formal footprint in a formal credit structure helps you a lot in attaining your personal goals, in attaining your financial goals. So yes, loans from that angle definitely helps you a lot. Now let's get more into whys and hows of it, how loans can actually grow your business. There can be various examples, and you know it more than I can tell you. That there can be opening of newer branches. You have a very successful store in one of the localities, now same opportunities coming up in the second locality, you open up a store. How do you fund that? You should take a loan. If you're into manufacturing, season is coming, demand is growing, product is getting accepted. How do you do that? Take a loan, expand business and fund it. Working capital requirements, raw material purchase and labor payments, day-to-day operational efficiency, all of these can be funded with the right kind of a loan. Again, emphasis is on the right kind of a loan. Don't take any loan. It's very crucial that you take right kind of a loan for the right kind of a requirement. Opening up a new branch, increasing production, these are different requirements than purchasing the raw material or managing the working capital. So both are should be, or both should be funded with a different kind of a loan, and that's what we would look at while we go deeper into this. But yes, all the needs that they are in the business, whether it's expansion, whether it's more production, whether it's more footprint, whether it's getting into a new market, newer product, can be funded and should be funded through the loan. Now, moving further, this, if you want to upgrade machine, if you want to build an online presence, now that has become more and more crucial. If you want to create a good distribution or a supply chain network, payment becomes very critical. And also, at times you need to create buffers. So this is more specific to the manufacturing side of the businesses. But yes, all of these again can be funded and should be funded with the right kind of a loan while you are looking to grow your business. Now, when we look at loans, coming to more important aspects of it, how should we choose for a loan? Again, I would like to give you an example over here. And again, very, very smart businessmen, MSMEs just like you, always compare the cost of the loan with the returns of the business. Now, we funded one of the very good fine dine restaurant. So fine dine restaurant means very good internal ambience, plush sitting arrangements. They're serving high quality, high cost food, and obviously this was a restaurant bar. So we funded them twice. They came to us in the first year. They borrowed money from us in the month of August, September. And while I was talking to the founder, the promoter, the businessman like you, I asked him like what would be the purpose, and obviously this was a high cost loan. So he told me very clearly, okay, what I'm gonna do is with this money, since we are serving our customers also the alcoholic beverages, we would gonna invest in this. So when you buy a huge quantity, especially people in the FMCG and FMCD market would know that there are schemes like you buy 10, you get one, you buy 10 or you buy 15, you get two additional quantities. So that directly gives you an advantage in terms of the cost. So with this loan, he would buy and stock his alcoholic beverages. He would take benefit of additional stock which would come to him. So obviously he would get a discount, or a 10 plus 1 means a directly almost 10% discount. A 15 plus 2 means more discounts. So he would stock all these alcoholic beverages. He would sell them in a smaller batches. So again, there is more profit over there. And he would continue to sell this by the month of January. And that's when the festival stops the going out stocks. So he would take advantage of that. And then he would repay by the end of the March. So what he is doing, he is earning roughly around 200% profit on that product, and what he was paying here of the interest. So that definitely is a very smart decision to do, because what he's doing, he's earning profit on a money which is not his. He's having his own working capital, his other lines available to him to fund his other operations, and he is able to generate more income for his business. So that's where you need to be smart and understand what is the cost of the loan and what is the business return you are able to generate from that loan. And if you happen to know this equation very well, then obviously you would never default in making a loan a headache for you. It would always be a growth enabler for you. So coming to the segment 4, wherein we would talk about, like I was mentioning time and again, what is the kind of loan, then where can you take them from, and what are the small things that you should look at while you are trying to fund your business. So there are different kind of loans that we look at. One is a working capital loans, the money which is required to run your day-to-day operations. So purchasing of the raw material can be a working capital, payment of the laborers can be a raw material. If you're into trading, then stocking the shop which you currently have becomes a working capital requirement. So all of these should be funded with the working capital loans. Now, working capital loans are comparatively shorter period loans, which are basically for you to service in a faster manner, and should be able to help you not fall into debt trap. Uh, Term loans are basically loans which are there for you if you are taking any capital project. So opening up a new branch altogether or opening up a new shop, that's a capital expenditure, and that should be funded by a term loan, not from a working capital loan. Working capital loans are slightly expensive because what they do is they are providing you money for a shorter term, but they can be funded well if you are having a even shorter working capital cycle or a credit cycle for that matter. For example, a kirana store would typically stock in 7 to 10 to 15 days, but you are paying EMI, which is a payment once in a month. So if it's a 7-day cycle, you can rotate that money 4 times. If it's a 15-day cycle, you can rotate the money twice. So that means if you are able to generate more income in terms of your profit percentage, then the rate of interest that you're paying, then you're good over there. But term loan, since your income will start at slightly later stage, the repayment tenures are slightly higher, which are like 3 to 4 to 5 years at times. The rate of interests are comparatively lesser, but yes, if you are using a term loan to fund your working capital, you would be stuck because your working capital cycle would come back again and you still have your old term loan on your head. So it's very, very crucial that you use term loans for expansion, for machine capacity buildup, for doing things which is basically not a working capital, more of a capital expanded expense based rather. Invoice discounting, bill discounting is something which is gaining more and more popularity in the structured market right now. It was always present in the older businesses, but yes, this is a faster payment. The entire market is aware of 1%, 2% cash discount. This is exactly what it is, and this is getting more traction. So again, important medium to unlock the future receivables or payables if you use this particular tool. Um, Overdraft or cash credit is again a loan wherein it is a line of credit available to you. All the businesses they use it, especially with the nationalized bank, very, very common and most used facility. Uh, the only drawback which you should be having in mind while using is don't keep your overdraft or cash credit over limit. I mean, the moment you do that, that's a red flag for the lending organizations. You should always use it wisely, judiciously. You should pay back it on time, and it should be utilized as and when needed, not for the other purposes of expansion or any other mode. But yeah, a short-term, flexible, recurring needs that should be funded through you. Then there are a host of government schemes like the CGT, MSC, the Pradhan Mantri Mudra Yojana. There are a whole lot of this, and these are available to businesses. Utilize them very, very wisely because these are very, very cost effective, very, very business friendly, very, very pro MSME schemes, and these are often subsidized. So the primary need for any working capital or maybe more of a capital expenditure, you can look at these schemes. Even uh, you know. Before you look at the other options. Now, if you're looking to have more equipments, then there are machinery loans available. Please use that. Don't fund it through a working capital loan. Uh, don't fund it through any other loan because when we talk about equipment finance, it becomes a secured loan, which basically means that you need to provide collateral. Sorry, equipment finance, which basically means a secured loan. That means your machinery are mortgaged or hypothecated to the lender. It means less of risk for the lending institutions, and that's where you need to kind of get a cheaper rate. And this is where it's become very, very important, crucial. If you are going for equipment based finance, if you're going for a machinery loan, go through this particular specific route. Don't take a term loan or any other loan. And then there are loans. If for example a banking based loan, so you don't need to submit a whole lot of document. If you're using a point of sale machine or a QR code, there are options available which helps you that do that. these becomes very, very critical for a retail businesses, not so much for manufacturing. So if you're into a retail business of selling something or providing some services like a hair salon or a restaurant or maybe a kirana shop or a stationery shop, using a QR code, this becomes important mode to fund your business. What it does, it helps you avail good funding for a shorter tenure, wherein you not only can pay them on a monthly, but there are also options available where you can pay them on daily basis. What it does, paying daily means your loans run faster, you can repay them better, and they don't create a huge burden on your pocket while you are servicing them down the line. So lot of different loans available for you to take, a lot of different opportunities. The only thing critical is to find out which requirement matches which loan and then take it cautiously. Now if you want to check like who all are giving you loans, so obviously there are banks, they have been available in the market for a long time. They give you lower interest rates, but there is a downside to it. Their processes are lengthy. They are very, very stringent in giving loans to people. And for taking loans with the banks, most of them, you need to visit them. They are trying to reach out to customers, but unfortunately, there's still a long way to go. But yes, if you are able to take a loan from the bank, obviously that becomes the priority. For the others, if you want a faster loan, if you want to take it on the go in your own environment and comfort at your own place of office and shop, NBFCs are doing a fantastic job. They are reaching out to all these people. They are talking to more and more segments. A lot of the segments which banks are not funding, NBFCs are giving good loans at a better rate of interest, and now they are giving huge loans as well. I know NBFC is giving loans up to 50 lakh, 75 lakh rupees unsecured loans on businesses. They do faster processing. They talk to a lot of segments, and they are also available to you at your own comfort. The new age lenders which are coming in are fintech lenders who are basically giving you loans with minimal documentation. So the loans are available to you without submitting any documentation. So you are just need to provide your basic information, your PAN card, your Aadhaar card, your addresses, just give access to your banking, and that's it. So these companies, they would underwrite you, they would evaluate you basis the information available through the different technology platforms, and they would give you loan. And the best part is not only they are fast, they are available to at your own comfort. Since there is no human intervention involved in most of these cases, you can take a loan at 1 o'clock at night and get the money in your account as well. So all of those things are possible. But yes, whole lot of improvement in terms of the availability of funds with the minimal of the documentation is where. And then we have cooperative banks and microfinance institutions. We have government based institutions who are also giving you loans again. So if you are into small businesses who is looking at easy access to credit in the rural and more interiors, obviously NBFCs and fintech lenders are most probably not available there. So cooperative banks and microfinance institutions, they become much better alternative for you. So that's where you can look at. And then of course SIDBI and Mudra and a lot of these institutions are giving loans to MSMEs basically to enhance their operational efficiency and growth. Now while you are looking to have these loans, what are the important things you need to look at? uh, like I said, first of all, you need to look at the cost of the loan and the profitability that you can generate through the loan. And obviously that goes hand in hand with the interest rates and processing fees. Please be very, very careful of the processing fees and the charges that you are supposed to pay. The government has made it mandatory with the new guidelines which have come into force, that the borrowers should be made aware of all the factors which are impacting their loan, both in terms of the costs and the fees. So look at that. Uh, then you should look at the repayment flexibility. Certain loans, they offer you step up or step down, which means you can pay higher EMI certain times, and certain times you can pay lower EMIs if there is cyclical business. Uh, then also look at the repayment options in terms of closing the loan or foreclosing the loan, if that is allowed, because that should be the priority. And also, what are the different factors which will help you get eligible for the loan? So like I mentioned, the banks, there is a different requirement. NBFCs, there is a different requirement. Fintechs, minimal requirement. So please evaluate all of these options. More importantly, the disbursement speed. If you can wait for the funds to come into your account in 8 to 10 to 15 days, and if you're eligible, obviously the bank becomes a lucrative or a more probable option. But if you are looking to capitalize on an opportunity which is there for you to take in the next 24 to 48 hours, then obviously NBFC or fintechs, they become more critical, because they have a faster disbursement at, they have an easier documentation process, and they also have availability outside of the office hours, because they work digitally. So that becomes one of the factors for you to check. And obviously the customer support, the digital presence of the NBFC, are they available to you through their app or a web platform? Because at times you would need to look at certain documentation in terms of your statement of account or repayment schedule. You want to know what is the foreclosure amount, or you just want to have a TDS certificate on the interest that you paid because your tax consultant wanted it. So all of those things, they do form a critical factor while you are evaluating the lending institution from which you can take a loan. Now, the entire ecosystem of the loans, it has been working on a word of mouth or a referral basis. So typically an MSME would, if I want a loan, I would talk to my friend, ki loan kahan se liya tha, he would refer somebody and I'll go there, because one, I don't know where to go. Secondly, I don't have enough time because I am managing everything on my business. I cannot leave my shop, I cannot leave my manufacturing to go and find out who is giving me what loan. And more importantly, I am not sure what loan do I take, because frankly I know my business, I know how to do trade, I am not a finance guy. So what I do, I just ask somebody, my friend, because he has taken loan, and I just take a loan. And unfortunately what it does, it makes you unaware or not exposed to the right kind of funding which is available. So what you need to do is obviously check on your own with all these inputs that we have discussed in the previous slides, what kind of loan suits your requirement and who is giving that loan. Always go through the institution which are verified and endorsed by RBI, who are regulated by RBI. So the NBFCs, they form under the purview of RBI. The fintechs, RBI controls them. The banks, of course, are under the control and strict vigilance of RBI, because what it does is that if they are looked after, controlled, and under scrutiny by RBI, they cannot charge you higher rate of interest. They cannot charge you very high amount of fees. They cannot charge you anything extra which is not supposed to be, because RBI is working very strictly for the benefits and the uh, the benefits for the borrowers. So what you need to do is just check that as you approach the lenders. If you're going through somebody who's helping you, check who is the authority or agency who's helping you apply for that loan. If there are middlemen who are promising you something with a very high charges, please make sure that you look at other alternatives, because typically a lot of these banks and lending institutions, they pay their sourcing partners the commission for the loans that they are sourcing. The middlemen are not supposed to charge for the loan services, but that's practically for most of the loans. In some cases they are authorized, but I would not get to there. But most of the 99.9% cases, the banks are paying the middlemen for the loan that they're sourcing. So prefer the authorized channels, prefer the known channels, prefer the channels who are, uh, you know, being there in the market for a long term, who are known for not doing anything wrong for their customers, or not known for asking extra funds or something. So that's what you should look at. While you are looking to get the loan, understand the terms very, very clearly. Only borrow money which is required for your business. Don't borrow for speculation. Don't borrow for anything extra. And while we are doing it, keep a clear track record in terms of your banking, in terms of your filing with the GST, in terms of your income tax returns and everything. While doing that, this should help you have a good credit score, and you should be avoiding anything which is not fruitful for you to get a good loan. So just to summarize what we have looked at, uh, borrow with regards to your needs in mind. Your business cash flow and your loan repayment should match, and you should be able to compare the interest rate, the fees, the repayment term. Choose the RBI regulated lenders, official borrowing channels without any undoing or wrong things. Clear banking records, honor your checks, timely repayments, clear GST return, and avoid, if you have any loan, wherein avoid repaying it beyond the specific tenure. So just to summarize, these are the important things you should look at, and that's all which I can help you with right now. If just look at it, understand it. If there are any questions, I'll be more than happy to answer. For now, looking forward to seeing you again, and happy borrowing down the line, and happy growth as well.
Okay, so I think that was very insightful session, Abhishek. Especially, I will say I like the examples that you gave, because that really helps us to understand quickly what is there. It's like when we tell stories to children, they understand more better than just talking through the theory concept. So I'm sure all of our MSMEs also would have understood and liked the way you put forward the things. Thank you so much for that. And like I said, we are always open for questions. So you can put your questions on our MSME TV, or you can also write to us if should you have any queries. And while we are, like I said, this is one of the webinar series we are doing to educate the MSME segment, helping them to clear some concepts, upskill them onto some new concepts. So we have been touching upon various topics. So right from the trademarks, or how to go digitize yourself, and now we are talking about loans. So if you have any suggestions or ideas, or as to what topic you are really looking forward to, you can also give us those options. So, and one thing, of course, our webinar is, while it is live on our app itself, Iris Peridot, and it is also live on YouTube. So for those who have not yet got our app, I would humbly request them, please download the app, because here we are, putting more and more features for our MSME. So be it, generating an invoice digitally, or finding MSME schemes, or even, seeing all this information live. Everything you will find in the same app, Peridot. So while you can continue doing your GST search, these are the additional set of things for MSMEs, which also will be there in the same application. And now we are soon going live with our, we would be going live with our finance option as well, which could be a very easy process of, getting loans from, right. You just need to upload your documents, and we connect to the lenders and get that done. And with that, I think you can go to the next slide, yeah, Abhishek. So with that, yeah, here is the QR code. You can always download our app. And yeah, if you have any questions, we'll be just there for a minute. Else not, we will end this webinar, and you can always reach out to us through any of our social platforms and email. Yeah. So thank you so much, Abhishek. It was nice to have you here, and we hope to see many more sessions with you as well going forward.
Thank you, Shilpa. It was a pleasure being here. Looking forward to doing this again. Thank you so much.
Sure. Yeah. Thank you so much.
Thank you, Iris team.